Hey, what is up guys? Well, what can I say? Seems like the Fed rate monitor tool was right. We got another 25 bps interest rate hike from the US Federal Reserve, and of course that followed with a pretty huge rally that got slightly dented on Friday after the release of what I would say disastrous earnings from the big tech companies, which I will cover for you today. But first, let's go through some of the macro data. The 10 to 2 year yield spread is now slightly lower than the previous peak as the Fed remained hawkish and said that there will be more interest rate hikes. So that naturally translates to the 2-year yield remaining at its current level, and hence why this inversion has not improved a single bit. Oil prices, slight reduction to the lower 80s, but what's more important here is that Europe is imposing an import ban of Russian oil beginning the 5th of February, and that could be an issue because the EU now has to look at other suppliers such as the US, and that will naturally bump up the US oil prices because demand increase while supply remain the same. But from what I understand, if Europe doesn't want to buy Russian oil, then China and India are ready to soup off those cheap oil. So ultimately it might just be a zero-sum game and Europe end up being the largest loser in the entire ordeal. And we have also got the Purchasing Managers Index PMI for the manufacturing sector, and boy, isn't it ugly? It has decreased another 1% from December, and very simply, any number below 50%, in this case 47.4%, means the economy is continuously contracting for a few months already, and we see new orders contracting for the 5th straight months. In simple terms, consumers are spending and buying lesser and lesser. But on the contrary, the services PMI index actually rebounded strongly from 49.2 to now 55.2%, a huge 6% comeback after the surprise decline in December, and this, as contradicting as it sounds, represents a solid consumer demand for services in January, and apparently people are still traveling and spending left and right for services, just not so much for goods, and that is actually supported by the blockbuster US jobs report that was also released last week, and we've got a 53-year low unemployment rate of 3.4% for the month of January, a 0.1% decrease from December. And the most surprising part, non-farm payrolls increased 517,000 in January, which is almost double from the 260k in December. I mean, wow, the jobs market is literally on steroids. Anyways, looking at the details, the average hourly earnings increased 0.3% month over month or 4.4% year over year. That's a little bit lower than December, and that makes it 2 straight months of wage prices decelerating. Small wins, but a very welcoming trend to see. But it's still too early to say that this jobs report will have much weightage on the next rate hike, because we still have one more jobs report to go in early March. And as much as I hate to say it, a soft landing might be in the picture again. Don't hate me for saying that, but all the data seems to be supporting that, at least for now. Anyways, let's dissect last week's interest rate hike. We got another 25 bps rate hike from the US Fed, and that makes the effective Fed funds rate to be 4.5 to 4.75%, or in simple terms, the interest rate is now up to 4.75%. Jerome Powell, the chair of the Fed, had two interesting takes. Number one, he said that expect the Fed to deliver a couple more interest rate increases before they pause, and this could very well hint at 2 more 25 bps rate hike in the coming FOMC meeting, the next 25 bps on the 23rd of March and another 25 bps on the 4th of May, and on top of the current 4.75%, that will make the terminal Fed fund rate to be 5.25% for the time being. And number two, they noted that inflation has eased somewhat but remains elevated, but they are still far from their 2% long run inflation target. And in case you need a little recap, the consumer price index CPI is now standing at plus 6.5% year over year growth after peaking at 9.1% in June last year. Meanwhile, the personal consumption expenditure PCE index stands at 5.0% year over year growth after peaking at 6.8% in July last year as well. And what this means is we are on our way down, but we are still very far away from the 2% target. So anything can happen until we reach that point, and the Fed can technically keep the interest rate as high as they want until something breaks. And that's why Jerome Powell said he thinks there will not be any interest rate cut this year. But of course, there are also more signs of inflation continuing its decline that not everyone is aware of yet. Oil prices in general has come down from the peak 120s to now stabilizing in the 80s for 2 to 3 months already. And energy prices, especially natural gas, declined more than 45% year over year. Global supply chain pressure index has also tumbled from its peak in December 2021. The Baltic Dry Index, which tracks the global shipping prices on a daily basis and is one of the leading indicators for inflation, has also fallen off the cliff. The Zillow Rent Index has peaked in early 2022, while the US rent CPI is still not reflecting that decline yet. And And another rental index, the National Rent Index by apartment list, also shows similar decline as of February this year. So when the rental prices are falling, that will definitely reduce the shelter cost portion in the CPI data. And the used car prices index also has fallen all across the board, and we have seen vehicle price cuts from Tesla, and now even Ford is joining that as well. Lumber, which is one of the key material for buildings and construction, has also fallen from 1 year ago, as there are lesser and lesser people wanting to buy new houses. Food prices, most of it if not all, also down year over year. Metal prices, same story as well. Year over year, it's mostly double digit decline. I can go on forever, but to me, everything seems to point to the same conclusion. Inflation is coming down because consumer demand is declining, and while the unemployment rate is still at a historical low number, I think we can assume that the Fed pivot could potentially be closer than the doom and gloom media is expecting. That's just my guess. I'm not saying you need to buy my thesis because I could be wrong as well, but just look at the numbers and judge it for yourself. Quick pause, if you like this video, you can support this channel for absolutely free by checking out Interactive Brokers in the pinned comment down below. Start trading with the most reputable and well-regulated broker that allows you to trade fractional shares in the US, for which many other brokers don't offer. And the best of all, their fee package is easily one of the cheapest among all other stockbrokers. Thank you so much. Okay, back to the video. So last week we've also got earnings from a bunch of big techs. Spoiler alert, apart from Meta, the rest of them pretty much confirms a broad-based slowdown in the consumer demands for electronics, e-commerce, cloud computing services, and digital advertising. Let me start with Meta. They announced their Q4 2022 EPS of $1.76, which is short of the analyst EPS of $2.26 by over 28%. However, their saving grace, their revenue for the quarter was $32.17 billion, beating the widely expected $31.53 billion thanks to the increased revenue from advertising, family of apps revenue, which is their Facebook, Messenger, Instagram, WhatsApp, and Reality Labs. And it seems like their advertising revenue has increased about 15% quarter over quarter thanks to the users from US, Canada, and European region. And being developed country as they are, does that signal a comeback of digital advertising as businesses start to deploy their cash to ramp up their marketing while their competitors are still hoarding cash? That could be one way to see it. Anyways, Mark Zuckerberg said that they will be leveraging AI this year to make 2023 the year of efficiency for the company. So I believe you can already guess what that means. More layoff of their middle management to reduce their operational costs and also just to improve their overall productivity. And on top of that, they also announced a 40 billion stocks buyback, which is more than the 28 billion buyback that they did back in 2022. So better operational efficiency plus stock buyback, that came up pretty well, and that's why the stock surged so much last week. Now, onto the not so great news section. Let's take a look at Apple's Q4 earnings. Here's the summary. Financials wise, total revenue of $117 billion, which is lower than the analyst estimated $121 billion by 4%. And this is their lowest year-over-year change in their revenue since 2016. EPS of $1.88 also fell short of the estimated $1.94 by 3%. Gross margin in the quarter was 43%, down from the 43.8% last year. And same goes for operating margin of 25.6%, a decline from the previous year's 27.9%. Cash flow from operations in the quarter stands at $34 billion, a steep decline of 38% from the previous year's $47 billion. And that, ladies and gentlemen, reduced their cash and cash equivalent to about $22 billion, a decline of almost 76% year over year. And in terms of their product sales, iPhone, their biggest product, down 8.3% year over year. Apple blamed that towards their China production plant issue, and Mac sales down 29.3% year over year. And Tim Cook said that it's because December 2021 they released new MacBook Pros, while their December 2022 release were actually delayed until January 2023. Hence why there is a huge discrepancy there. And wearables sales down 8.2% year over year. And the only segment that are not down are the iPad sales, which is up 30.6% year over year, and the services sales up 6.7% year over year. And Apple said that they are now beta testing a buy now pay later feature within their company and will launch that feature to the public very soon. And geographical breakdown wise, the sales in Americas dropped 4.3%, Europe dropped 7%, and Greater China also dropped 7%. Overall, pretty bad numbers, and that's reflective of the decline in the consumer demand, no thanks to the aggressive rate hikes by the Fed, plus all the production issues in China. But Tim Cook mentioned that there could be a rebound in consumer demand in China as the country lifted their COVID-19 restrictions, and he also said that Apple's production problems in the country, especially at their Foxconn Zhengzhou plant, has improved, and also comes on top of their effort to diversify to various plants in Vietnam and India. Products-wise, Apple has so far this year released more products like the HomePod, as well as the Mac Mini and MacBook Pro that comes with their new M2 chip. And this year we can expect more new products like the M2 iMac computer, a revised Mac Pro which is for their higher end users, more iPad that probably comes with the M2 chip, iPhones that potentially comes with USB-C port, and also probably a glimpse into their AR VR glass sometime later this year. Now let's move on to Google's Q4 earnings. Their total revenue of 76.05 billion barely misses the estimated 76.07 billion. Their EPS of $1.05 also fell short of the estimated $1.18 by 11%. Google search revenue declined 1.6% year over year, and YouTube ads revenue declined 8.4% year over year. Google Cloud revenue increased 24% year over year. Operating expenses increased 16% year over year, driven by the growth in their headcount and their ongoing legal battles. Operating margin stands at 26%, a drop from the previous year's 31%. Google also signals for lower demand for their Google search engine as the economy slows down and there are fewer advertisers or businesses keen to spend on ads, because if there are lesser buyers in the market, there is no point spending so much on marketing, right? And to add fuel into the fire, their core advertising business is also under threat from the US Department of Justice, where they are suing Google for monopolizing the search engine business, and they want Google to break off their Google Ad Manager from their advertising business, and that will definitely have a pretty severe impact on how Google control the market when it comes to digital advertisements on various other websites. And in case you forget, Microsoft invested OpenAI's ChatGPT is also posing a threat to Google, and in response to them, Google has officially declared a code red response, doubling down on their AI research department, DeepMind. And let's not forget, YouTube is also facing ferocious competition from TikTok in short form videos. So more competition, more lawsuits, lower consumer demand. It is indeed a very tricky situation for them to be in right now. Moving on, we have Amazon. Their net sales of 149.2 billion beats the estimate 145.6 billion by 2.4%, but their EPS of only 3 cents falls short of the estimated 17 cents by 82%. Their Amazon Web Services AWS sales increased 20% year over year, but still fall short of estimates by 2%. So for the full year of 2022, they actually had a net loss of $2.7 billion, a huge difference if you compare it to their 2021's net income of 33.3 billion. So that makes 2022 Amazon's first unprofitable year since 2014. And the biggest contributor to their loss in 2022 was their 20% investment in Rivian, the EV truck automaker, which saw its share price plummeted over 80% in 2022. Rivian was an ambitious attempt to replicate Tesla's success and held one of the largest IPO in US history, but they have made numerous pricing hikes and missteps, which led to them falling short of their growth targets. And to add salt to their wound, a growth slowdown of their cloud computing business, which is their main profit maker, also delivers a huge blow to its share price as companies scale back their digital expansion plans in the face of high inflation and interest rates, similar to what Microsoft is facing with its Azure cloud services as well. And because consumers now have reduced appetite for online shopping, Amazon was forced to start laying off their employees and reconsider their warehouse expansion plans, which includes closures and planned cancellation of 42 of its US facilities in an attempt to reduce both capital expenditures and also operational costs. They are also reported to delay the opening of 24 facilities that were initially planned for opening in 2023 to 2024. Well, what can I say? They are definitely struggling to keep up with the rate hikes as they lost almost half of its market cap in 2022. But luckily, the tech rally in the last few weeks managed to recoup some of that for them. So upcoming important dates for this week, it will be a fairly quiet week since there are technically no big macro data announcements, and we'll only have interesting earnings results with Disney on Wednesday. Whether or not they can keep up their pace with Netflix and also other streaming companies is a black box right now. And on Friday, we'll also have earnings from AbbVie and also PepsiCo. Not as sexy as the big techs, but we'll also be able to see the medical cost inflation from AbbVie's report and also hear what PepsiCo is saying for their forward guidance from the standpoint of a consumer staple stock. So that will be interesting for me to cover. Alright, that's all from me now. Hope you found this update useful. Have a great week ahead, and I will see you in the next one.